All right, welcome to the Small Caps Introduction webinar series. This webinar is brought to you by JSE-listed, which is a financial problem-solving resource, and you can always follow them on social media, including LinkedIn, Facebook, Twitter, and Instagram. I'm Nastassia Arendse, and I'll be with you for the next hour as we basically talk to the CEO of of EasyEquities, Charles Savage, about the investment case for Purple and where he sees the group's business headed for the next few years. Now, as part of the commitment to raising awareness of small and medium cap companies on the JSE, we're giving investors the opportunity to engage with management at a variety of JSE-listed businesses. We kicked off last week speaking to the founder of Orion Real Estate, and this week it's the Purple Group. So at the end of this discussion, we're going to have about 15 to 20 minutes of Q&A. I've already seen a lot of questions come through, and I'm pretty sure Charles is more than excited to get through all of them. There's about 66 participants so far. We're expecting a lot more to continue, joining as we have the discussion. The wonderful thing is that EasyEquities will be awarding each attendee with a 50 Rand voucher. So a member of our team will be able to contact you after the webinar, get your EasyEquities account number and email address associated to your account so that EasyEquities can load the voucher to your account. And of course, there is a lockup of 1 year for the value of the voucher that's issued. So you'll only be able to withdraw the value of the investment after a year. So this gives it some time to grow, which is what you want. But we're going to get right into it and welcomes Charles Savage, the CEO of the Purple Group. Charles, thank you so much for your time.
Thanks, Nastassia. It's always very lucky to get into a chat with prospective shareholders, users, and with you especially. So thanks for having me on.
Awesome. So, let's take it all the way back because this is a fascinating story. It's an inspiring story. And I've heard a lot of people, describe what you've done and they're super impressed. I can imagine some people had doubts, but we're going to take it back to, say, 2013, when you were on a beach in Mozambique. What was happening in that period in time?
Yeah, it is a fascinating story. I go to Mozambique for a month, a year. It's been going on for quite some time, and it's really to spend time with my family and sort of reflect on work and get ready for the new year. And back in 2013, I was losing passion for what I was doing and was trying to find some purpose in all of it. And I was having various conversations with my family around what I did, and one of the conversations led to the fact that none of them, and just to go back, my wife's been with me for almost, or this year it'll be 20 years, and I've got a 20-year-old, well, back then he was only 13, but I've got a 20-year-old son, a 19-year-old daughter, and another little daughter who's 11. But back then I was talking to all of them about the simple fact that none of them had ever bought a share for themselves. And whilst I could find lots of excuses for people who didn't live in a circle where their father or husband was a stockbroker, they didn't have any excuses, I felt. And we had a very honest conversation about it. And in that conversation, they had varying answers, but fundamentally, they all felt like they were too stupid to invest for themselves, that the interfaces through which I insisted that they invest were too complex, and used a language they didn't understand, and they didn't want to look stupid in front of anyone, and especially not because I was their father and they should know better. And so in understanding their friction points and what was stopping them, I realized that my family looks very similar to lots of other families in South Africa. And that same conversation, the further you get away from someone who works and lives inside financial services, the harder it must be for you to access financial services like buying shares. And so I realized in that moment that actually everybody wants to own shares, but the financial services had intimidated us out of owning them. And that if we changed that dialogue, if we changed that paradigm and focused on eliminating the friction points, there might just be a new wave of investors that would rush to the stock exchange. And that's where it all started. I've always thought that the internet would bring about a radical change or radical transformation of the ownership structures on the exchange. But 2013, the excuses around why people couldn't access the internet were starting to be eliminated. I mean, when I started this in 2000, or started my journey in financial services in 2000, there were no smartphones. Very few people were banked. There was no low-cost data. It was all really expensive data. And you were accessing everything on a 28.8K modem. So there were lots of excuses. But today, with the proliferation of smartphones, lower data costs, access to all of the ecosystem that allows you or affords you the ability to do transactions online, those excuses have evaporated. And so the financial service industry has to look at itself and say, well, given the fact that the ecosystem is ready for this disruption, what are we doing about understanding the friction points that we're putting in front of our customers? And that's what EasyEquities was born out of. And we made it our mission to democratize share ownership in South Africa. But more broadly, that if we have any semblance of success here, that there are lots of markets all around the world that have the same problem. And that is that less people than you would think own shares directly on their respective stock exchanges. And even places as mature or as large as America with big fintech ecosystems, only 21% of Americans actually own shares directly. In places less mature or more emerging market, places like India and Russia, less than 2% of their population own shares. So we felt if we could solve the problem here in South Africa, South Africans look very similar to lots of other markets in the world, and maybe we could solve the problem elsewhere.
All right, so you think of this idea, and I can imagine it, to other people when you shared it, it sounded like a very noble cause. Were there any other businesses that, gave relevance to what you were trying to do? Because this idea that you're thinking of sounds great, but how do you exactly roll it out?
Yeah, I mean, the first thing was that the idea, every time I said it out loud, everyone that listened to it went, yeah, we've got to do that. So it was, and it was amazing. Like I remember a couple of meetings where I bounced the idea of people who are not like me. And in every single instance, it was, yeah, we've got to do that. We've got to do that. The problem was we didn't know how we were going to do it. It was just an idea. We had no idea where it would go. So what we did is we created a rule set or a set of rails along which we could create the business, which had no foresight on what it would become, but set rules for what it wouldn't be. And we leveraged off three business models extensively. The first was Amazon. And I know, every CEO that I've listened to in a fintech platform wants to replicate Amazon. But we found relevance in Amazon. One is, the thing about Amazon is that you can't differentiate, and I'm going back now to Amazon's journey back in 94, I think, when they established themselves. When Amazon just sold books, the only differentiation between one online bookstore and another was the price of the books. Otherwise, everyone's got the same books. And the price of the books is not something that's that elastic. You can't make it that much cheaper. So if walk down to Exclusive Books or buy it in CNA or buy it online, the price point is not that different. It's not a really compelling reason to buy books online. And Amazon worked out that actually the biggest friction point to buying books was that people didn't know what books they wanted to buy. And so they surrounded you with book reviews so that you could learn from what other people were buying, make connections with those people, and then that would lead you on to more book purchases. And I don't know why it took us 13 years to work it out, but if you think about it, how different is that to the discussion on shares? I mean, for most of us entering the market for the first time, we're just like those book buyers. We don't know what shares to buy. We don't know what unit trust to buy, what advisors to trust, etc. And so we needed to behave like Amazon. We needed to ensure, and we couldn't control the price of our books. The share prices are controlled by, supply and demand on the exchange. So we needed to ensure that we created a platform that allowed people to make connections with other people and have the confidence, build the confidence to buy their first share, and then the journey would start. So Amazon was one of them, and a lot of what we do, we still reflect on that Amazon storyline. The second one was Uber, and I'm a proud shareholder in Uber, although I've made no money and still cannot work out how they're going to make money one day. But what I love about Uber is that they were the first business I'd ever seen that placed the customer at the center of their value. And what I mean by that is they placed more value on you as an individual than on what you would spend with them. So if I spent 1,000 Rand with Uber or you spent 10 Rand with Uber, we had access to the same services, the same cars, the same drivers, the entire same ecosystem. And what they did is essentially democratized access to a private driver. And they were so serious about it that they hid the transaction value away from the driver. They still do. The driver doesn't know how much you are worth to him or her until they've already delivered the first part and most important part of the service, which is to get to your house quickly. And when I reflected on that, I said, you know, that's incredible. That's the first business I've seen that actually says you are worth more than what you pay me to service you. And importantly, they did it. Well, I think they did it because they wanted everyone to be an Uber fan. They realized they couldn't outmarket the incumbents at the time. And so what they wanted you to have was an experience, I'll call it an Uber experience. So when you got out of that car for the first time, you went, my word, that's not what I was expecting. And you told your friends and family about it. And guess what? They then went on and bought taxi rides from Uber. And so for us, it created this challenge that we weren't going to outmuscle, outmarket the competition. We were never going to spend more than ABSA or Standard Bank or Nedbank, but we had aspirations to be bigger than them. So we needed our customers to be our biggest fans. And if we wanted everyone to be a fan, we had to ensure that the 5 Rand investor had exactly the same platform and capabilities, products to buy and services as the million Rand investor. And Uber, that was probably the most fundamental guide that we got in the early days, is that everything we did needed to be true to that Uber principle. And then the last sort of strong influencer, and not the last, but up front, one of the strong influences was social media. And back then it really was just Facebook and Twitter who were dominating the airwaves, social airwaves. And the reason it was important for us to be socially relevant was 2 things. One is I'm experiential in everything that I've done. I can't say that I've learned much from textbooks, but I've learned a lot from standing around people that are better at playing games than I am. And I'm talking about all the games in life, you know, from a kid starting to play rugby or water polo to learning how to, you know, get enough just to get through maths, to university, to being a CEO of a listed company. I've always had the luxury of standing around players that are better than me. And that is exactly how I run my business too. I have players that are much stronger than me in lots of areas, in fact, most of the areas. And social media was a platform that allowed us to put the strongest investors right in front of the investment community. I mean, as a retail investor today, you can go onto Twitter and follow as many as you like, but you don't need to follow more than 5 or 10 investment gurus. And they're going to teach you from every single move, and they'll engage if you question them, respond, publish research, and guide you on the journey. And so for me, social media, we had to create a platform that allowed people to share their experiences so that they could become centers of influence in their communities to drive this democratization. And then the other reason was for social media was that it's just, you know, if you're not socially relevant today, then to be honest, for me as a business, you're probably going out of business. And so for us, it was important that the pulse of the business happened on social media, that we were engaging and transparent and open to everything that was said there. And I think anyone who's followed us and our journey will pay testament to how active and how engaged we are as a group, you know, from me all the way down to everyone that's in the organization. So those 3 businesses were our guiding lights, if you like, and they set a framework for what we were going to build into the future. And then as we went along our journey, we just listened very carefully to our customers. And they were the ones that helped us shift course, which was also a big difference for me. I like to invent businesses and products and services. And prior to EasyEquities, I invented all of them in boardrooms talking to myself mostly. And that doesn't work. You know, the modern economy and the millennial mindset they want to be co-creators. They want to be part of the storyline and the journey, and they want to be able to change things up. And you see it in every industry. You see it in the car industry where you get to choose the color of your reflectors or the, you know, two-tone your car or whatever it is. this level of personalization. And so we felt the whole time EasyEquities has paid tribute to our customers' needs and wants, and we've built products and services and platforms in response to their needs. And that continues to be what sets us apart now. I mean, on Thursday, we're launching a business that is called Easy Properties, which I'm hell of excited about, and I'm sure there are thousands of users that are excited about it. But we didn't build that in a boardroom. We did a survey 2 years ago, and we asked our customers back then, there were about, I think there must have been about 30,000 customers then, and we said to them, what is the one asset class that we haven't given you access to that you would really like to own or invest in? And we thought at the time it was going to be crypto, because crypto was all the rage and everyone was investing in Bitcoin and we didn't have it. And interestingly, 60% of our customers said they want access to residential property. And that caught us off guard. And we realized that there was nothing in the residential space on the JSE. And then when we asked our customers, said, why do you want to own this residential property? The answer was also eye-opening for us. And the response, again, was, we live and work in places that are far apart. We spend way too much time getting to and from work. And we want to be able to save up and invest in properties that are closer to the destinations that we work. And we realized there was no product that allowed you to do that. Where could you buy a fraction of a big residential development, a Melrose Arch or wherever? And so, we end up creating EasyEquities, Easy Properties out of that. And that's how we continue to differentiate, stay engaged with our customers, understand what their needs and wants are, and then doesn't matter how difficult it is to execute that, get it done. Easy Properties is a great story behind that too. I mean, when we started, I thought it would be easy. And, 2 years later, here we are, the platform's about to go live. There was nothing easy about it. But in the final product, it's a really cool, easy place to go and create a portfolio of very, very nice residential developments.
I suppose, Charles, one may say that, prior to you guys coming onto the market, the financial services industry was probably the largest discriminator, in the sense that you spoke about the two different types of investors, the one that has 5 Rand and the one that has R1 million. And the two of them would be treated very differently if they went to, I suppose, any other financial institution wanting that opportunity to buy shares in order to have some kind of ownership. Talk to me about how important it was for you guys in the beginning to think about the purpose first before the costs and the profit, because there's a lot of, people want to make money, especially as a financial service provider. I get something, you get something. There's a lot of minimums that I got to pay, or I got to, put up front before I even get a piece of the action.
Yeah, it's a great question, and it reminds me, I've started a few businesses in my life, none of them that successful. EasyEquities definitely changing that. But when we built EasyEquities, the last thing we did was we built the income statement. Now, every other business, and I'm sure there must be some entrepreneurs listening in, but every single other business I've built, you come up with an idea and then you straight to the income statement. You go, well, how do we make money out of this? And then you sort of got to make some assumptions about how many customers you got and what are you going to charge them and what is going to cost you to build it, etc. But we didn't do that in EasyEquities until we had finished building the product. And the reason for that is that the purpose of the business is democratization of owning all things investing. It gained so much momentum from our staff, from our shareholders, that nobody worried about asking how we're going to make money from it. And I remember it very clearly. Ronnie Lubner, who was one of our largest shareholders and sadly passed away about 18 months ago, he was on our board, and he's just an incredible man and very philanthropic. And it was a board meeting, and EasyEquities had launched in October, and it was a board meeting in November. The board meeting was coming to an end, and there was no EasyEquities income statement on the board meeting. And he turned to me, and we were about to go. He said, Charles, listen, you haven't said anything about how we're going to make money out of this EasyEquities. And before I could answer, and he said, yeah, that sounds about right. We'll work it out. We'll work it out along the way. So, it was around, it had the central purpose that we all bought into, and we all wanted to invest our time, our money, our efforts in. And then we sort of worked it out along the way. We had some assumptions around what we thought we could create. we got all those assumptions wrong. I mean, the one thing about exponential is you can't predict it. So why anybody tries to budget for exponential, it is still amazes me. But we finally have become profitable. I mean, it was signaling in our half-year results, so it shouldn't come as a surprise that we're now profitable. But it wasn't something that we focused on early on. We focused on the central purpose and mission. And as that got more and more momentum, we worked out very slowly along the way how we could become profitable. But importantly, we needed to ensure that at every point that we tested something, it didn't detract from our purpose. We didn't put something in that made us profitable, but actually removed our purpose. And it was about ensuring and staying true to the fact that there had to be a home for the one-rand investor. And we're all one-rand investors at some point in our lives. I mean, I bought 1 rand of a stock, and I remember I bought Taste Holdings when it was collapsing. And I bought it for a reason that I wanted to get the annual report, and I wanted to understand what was going on. And I thought, look, why not just buy 1 rand of it? That's not a good investment case. But there are also sectors that I dabble lightly in. But, for example, I've bought cannabis ETFs in the US. Now, I haven't committed a lot of capital, but I want to be part of that journey. I want to understand what's going on and stay engaged. And the best way is to get invested. So we're all 1 rand investors at some point in our lives. Whether you're a 12-year-old kid, or it was my daughter's birthday last week, and she got a whole lot of different gifts, and the best gift was she got given a voucher for EasyEquities. And I asked her what she's going to do with it, and she's going to pitch up on Thursday, and she's going to buy properties on Easy Properties. She's 11 years old, and she's making those decisions, and she's not making them because I'm her dad and I'm telling her to doing it. She's just surrounded by lots of people who are doing it, and she's taking that energy and excitement and translating it for herself. And that means that she's going to go buy 120 rand of a property on Thursday. And that's so cool. And so for me, we had to stay true to that purpose, not because we were trying to serve a low income group, but because we realized that at different points of our lives, we're all 1 rand investors, and we all want to participate.
All right, so I'm going to ask one question because I can see there's a whole lot of questions coming in, all for you. So I'm going to squeeze in one more from my side, and then the rest I'm going to, leave it to the Q&A guys, who I see some of them already have their hands up. There's, I think, just over 15 questions. So we'll make sure that we get through as many of them as possible. My question is to you, Charles. We started off the year, and I think a lot of people had various assumptions about what they thought 2020 would bring. And then we, found ourselves in this environment where we're dealing with a pandemic, and that's basically changed everything you thought you knew was normal. We're now moving into a period where people can't even decide, do we call it normal? Is it a new normal? They don't quite know. For you, since, say, I don't know, the beginning of the year, around about now, what has been the biggest surprise for you when it comes to EasyEquities? And are you seeing that there's clients suddenly wanting to invest in the market?
Yeah, it's, this isn't what we expected, let's be real, about 2020. So nothing that has happened in 2020 has met our expectations. That's greatly surpassed our expectations. And we were doing really well. We had very strong momentum into our February results. And then we had March, and COVID arrived, and then things just got big on us very quickly. And when I say big, I mean, to give you some credence to the numbers, in February, and also just so that you understand, what do we budget for? We budget for 100% growth on year on year. And it's funny, when I sit down with analysts, the few that pitch up and listen to us, when they say you're budgeting for 100% growth, they sort of laugh at us. Whatever, you'll never do 100%. So anyway, that's how we budget. And everything was on track in February, i.e. our budgets were looking like 100%, everything was moving fine. And then March arrived. So to give you some numbers, to give you the context of how big it got, in February, we opened about 12,000 accounts. In March, we opened 62,000 accounts. So we had to scale the business by 500% in 4 weeks. And we had to do all of that in lockdown. And you can imagine how much more difficult that is when your team are working remotely for the first time. A lot of them working remotely for the first time. your infrastructure support, the people that you outsource, your hosting providers, your data providers, everyone's dealing with their own scale issues. More people are using data from home than ever before. And so all this infrastructure is under a lot of pressure. And we're having to scale at 500% in 4 weeks. And then it just didn't stop. March turned into April, April into May, and June, the momentum continues. And so you can imagine what kind of pressure that placed on the business. And there were lots of areas that we failed at, that we weren't ready for. And, with hindsight, we could have said, okay, guys, what did we get wrong? Well, we didn't budget for 500% growth. And, maybe next year we'll budget for that kind of growth. But we had to deal with that in COVID. And I must say to my team, and I'm sure some of them on the call, they did an extraordinary job. Because this is the hard part. This is what we dreamt about, but very few believed the dream. They wanted to believe it, but a lot of them didn't believe it would ever happen and ever happen this fast. And it just got so big on us so quickly, and we had to cope. And all of the exponential businesses that you read about, at some point in their journey, this happens. And a lot of the time, it's for an unexpected event. Something happens, and that becomes the catalyst for the success of that business. And it had nothing to do with the executive team or the strategy. It was just an unintended event that pushed them into the stratosphere. And that's where we are. And the thing that will never be the same again is the world will never, ever transact in the same way it did pre-COVID. We will never see the behavioral buying change back to the statistics and the way people bought pre-COVID. This is an inflection point that I believe will forever change the digital landscape, where there are two types of businesses, those that got caught pretending they're digital and those that are digital. And the ones who pretended they were digital are going to pay a lot more attention to their digital strategies and platforms and capabilities, and you're going to see the emergence of wonderful digital businesses over the next year, 2 years, and 3 years. And then those that are truly digital are going to create a gap between them that is almost an unassailable lead. And you're seeing that. I mean, just look at Amazon's share price since we went into lockdown. I mean, I was up 100% pre-lockdown on Amazon. I only bought it about 3 years ago, and it's up 70% since lockdown. And why? It's because the digital business, the platform that it's enabled, it's ready for this digital world. It has been ready for a long time. It's just been waiting for the right event. And so the digital warriors that have dominated the space are now creating an unassailable lead. And I think that EasyEquities fits into that. I think EasyEquities has got an unassailable lead now. Now, I don't want to be arrogant with that statement, because they are very, very strong and credible competitors. And so we will never not stay relevant and stay aware of what our competitors are doing. But I do think we're creating an unassailable lead. I mean, we are now 250,000 active investors. Remember when we started, there were only 280,000 active retail investors on the JSE. So we've almost doubled the size of the JSE in terms of retail participation, and we are onboarding around 2,000 customers every single day. And there is a positive force behind our brand, and there is a trust factor in what we do that I've never seen. I've never seen this happen at this rate and pace in the South African context. I think the closest might be Capitec.
Yeah. We'll speak about Capitec just now, but the first question that's come in says, did the average revenue per user increase over the lockdown period measured over the same months in 2019?
Yeah, that's a good question. And yes, it has. And it'll be, I think, the insight to understanding that, there's two key reasons why. Volatility in markets generally means that people invest more, because they get into investments and out of investments because things are moving around faster. So volatility always means increased revenue for stockbrokers. That's the first one. But interestingly, that is the smaller factor. The bigger factor is that we've never seen capital inflows like this. So exactly for the same reasons that I talked about, February was 12,000 investors onboarding. March was 60,000, and 60,000 investors come with a weight of capital inflows, so lots of purchasing that we hadn't seen before. So the weight of capital was large and volatility was large, and that combined to see a big increase in the average value of customers.
All right. The next question says, will Purple Group look at reinstating a dividend this financial year?
No. You've got to look at us. We're a growth company, and dividends are for companies that have got nothing better to do with their money than give it back to shareholders. We're not Apple. We've got lots of aspirations and lots of things we want to do, and lots of things we want to invest in. We're just getting started. This is, I think anyone who's watched this business for the 5 years will know that when we talk about EasyEquities, we talk about a 10-year plus time frame. In fact, I talk about the fact that I'm not going to be here to see the real fruits of what we're creating here. And what I mean by that is that I don't intend to be around in 30 years' time. And in 30 years' time, there are going to be thousands of Warren Buffetts walking the streets of Joburg and Cape Town and everywhere else that started their investment career on EasyEquities. And when that happens, we're going to be managing this massive platform, massive infrastructure, and millions of customers. So this is not a short journey for us. And so if it was, then we could pay dividends back. If we thought we'd achieved our aspirations, then I guess we could start paying dividends. But we've got lots of things that we want to invest in, lots of things that we want to do, not just in South Africa, but outside South Africa. We've just about to launch Australia. We're in key partnership discussions in Kenya. We think we can replicate easily the success we've had in South Africa across Africa. There are places in Europe that are interesting to us where other people haven't thought about taking the business there, and sort of, people are focusing on the USA and the UK and, first world economies. The third world is a big place, and there are lots of places that we'd like to go and build a business and replicate what we've done in other markets.
All right. The next question says, can we expect that the costs have found a base and it will increase at a slower rate going forward?
There've been no increases on costs. So the costs are the costs are what they are. They're not going to go up. I think if anything, the cost pressures on the industry will continue, and you'll see costs come down across the industry. And that, in certain instances, that might affect us too. There might be places where we get cheaper as we get bigger. I certainly don't see costs going up. New services might be priced differently. So what I mean by that is, a bit like Uber. Uber has, standard, and then Uber Black and Uber Van. I think EasyEquities will move into that model shortly. I think there's functionality stacks that are more expensive to manage and implement that people might want to pay for, and if they do, then they should have the choice to pay for it, and we shouldn't impose that cost on investors who don't want to pay for it. So I do see the business, the platform in the future having multiple service offerings where you can pay less or more based on what you choose, a sort of shopping cart of functionality.
All right. The next question says, is there an indication from Charles about the performance of the CFD business and contribution to profitability?
No, there isn't, because our results are out to February, and there's no one else. We can't give any inside information out. But I'll say this, and this is sort of public. I think anybody who reads the financials of any of our competitors and the public statements from all of our competitors, there are certainly more clients and there's more volatility. And so you should expect better things from anybody who's operating in this sector.
All right. And then we have a question from Gabelo, and he says, he's a member of a stokvel that's acquiring ETFs on a monthly basis on another platform. However, in the future, they have aspirations to move to EasyEquities. And he wants to know, when will EasyEquities allow stokvels to buy shares on the US and ASX market?
Yeah, good question. We obviously do allow it for South African shares. The rest of the world doesn't know what a stokvel is, and so they don't know how to regulate them. And we've obviously we have to comply with international legislation when we go to those markets. But it's a good question, and just because they don't know what they are, maybe we just need to find a way to do it. I don't have the answer, but I'm going to think about how we could enable that and allow that to happen. And if you get his details, then I'll come back if we get a positive outcome and how we could make that happen.
Okay. Yako wants to know, what are the plans to handle the expected increase in traffic once Capitec clients join? And you were talking about Capitec a little bit earlier.
Yeah, I mean, so Capitec is a budgeted event, so it wasn't a surprise. We've spent 18 months building that infrastructure. I mustn't say Capitec built the infrastructure, the platform on which the Capitec customers will transact, and they are doing their own testing and validation of that infrastructure. It obviously integrates into our infrastructure, so it's something that we've been able to plan for. So the infrastructure is ready and waiting for that to go live and being tested as we speak. So there won't be any surprises on being able to meet that demand. It's a demand that we can budget for and therefore plan for, and so there'll be no surprises.
All right, then we have a question that says, what percentage of profit does EasyEquities make per trade?
It's there's no set percentage, because if you think about it, it's a bit. If you let's just take the 100 Rand investor. So someone invests 100 Rand, pays us 25 cents in brokerage. Now, if we went and if he was the only investor, he or she was the only investor in that stock. So let's just say you buy 100 Rand worth of purple shares, and that's the only investment that happens on that day, then we would lose about 85 Rand plus VAT on that trade. Whereas if somebody invests R1 million on a single stock, then obviously there's a whole lot of profitability because our costs are much lower. So you can't work it out at a per trade level. It's all of the transactions happening on the platform at the various times. We aggregate them and then hedge them into the underlying market, or trade them into the underlying market, and out of that we make a little bit of profit, and you can see what that profit is through our financials. But for the last 5 years, we've made a total, I think we'll get to 150 million or 180 million in investing in the platform and in the losses that we've incurred at enabling this business. But it's a high watermark kind of business. And what that means is once we breach that cost threshold, then everything becomes profit. And as I said earlier, we've just breached that cost threshold, and so we're starting to be profitable.
All right, so this question is quite long, so I'm going to try and just basically have a look at it pretty quickly and give you 2 points that the attendee wants to know. The first one is, can you clarify the statement that you made at an interview saying that one of your biggest regrets was buying purple at 2 Rand, and do you see it getting to 2 Rand again? And the second part to that question is, what is the connection between Emperor Asset and IP Global Momentum Fund?
Cool. So the first question, yeah, I mean, I bought purple at 2 Rand, and I think it was 9 months later, we were trading at 9 cents. And I put pretty much 100% of my wealth into purple. That's how much I believed in what we were doing. And so I say it was my biggest mistake, is because you shouldn't really put all of your eggs in one basket, and it doesn't matter how much you believe in a business, it doesn't warrant that kind of risk. But that's who I am. So it's not a model for others to follow, but that's how committed I am to the business. Fortunately, I've bought a lot of shares below 2 Rand too. So I didn't stop buying when it got to 2 Rand. I've bought all the way down, and my average entry, I think, is sitting at about probably 80 or 90 cents now. So we're not that far from there. And yes, I do intend to make money on the purchase. And importantly, I do expect that we get to 2 Rand at some point. When, I don't worry about. Again, it's like going back to the original business model. And I know that lots of investors don't like it, but if we stay true to what we're trying to do and what we're building, then the profitability and share price will look after themselves. And so my focus is just on ensuring that we keep doing the things that we've been doing right, and then the share price will follow, and so will profitability. And then Emperor Asset Management is our asset management business. It's 100% owned by the Purple Group, and its relationship with IP Global Momentum is it is the fund manager on that fund. That fund, the only reason it's not called Emperor Asset Management is we white label the Manco, and the Manco is run by IP Global, and so we use their infrastructure to manage the unit trust because we don't have that infrastructure. But we're the manager on that fund, and it's a good point just to highlight its success to those who don't know. But Emperor, that fund, is the number one fund in South Africa year to date, and is number one all the way out to 3 years against much bigger brands in the business. So it's a business that's very small in our lives for now, but we're very proud of, and we're building a really good asset manager, and an asset manager that is very different from the current incumbents. All of its decision making is driven by algorithms. It's a quantitative manager, and so it uses machine computational maths and AI to make its investment decisions, and that's proving to be a much better way to manage assets in the future.
All right. The next question says, Charles spoke about competitors. Does he mind elaborating on this rather? Are these local competitors or alternative international platforms? Where do you see the biggest threat?
Look, South Africa is as much as we like to think it's a big market, it's not. It's a small market. And so international competitors very infrequently come and play in our home turf. And they don't do that. One, the market size is not that big, but two, exchange control is still a thing. So, it's difficult for the internationals. So, but we watch them very closely. I mean, we are acutely aware of all of the strategies of our big competitors, and we play right up against guys like Robinhood, who's a market leader in DIY investing in the US. We also watch Betterment and Wealthfront, who are the market leaders in the US on robo-advice, and then there are platforms that we watch in the UK like Free Trade that are replicating similar business models and elsewhere. So internationally, we stay abreast of what they're doing, and we also do what Steve Jobs did so well, which is steal with our eyes. If somebody does something that we really like, then we'll see if we can improve it and implement it, so we've got to stay abreast of what's going on. Locally, the big banks are the incumbent competitors. I mean, they've got an unfair advantage, or they had an unfair advantage to us in terms of distribution because they sit on side this big infrastructure with lots of customers. I guess we've turned the tides on that because we're bigger than any of them now by retail number of customers. But they have got the balance sheets that if they want to take this business seriously, they could invest very, very seriously and look to disrupt themselves. And so we take them very seriously, and they're good operators. We watch Standard Bank very closely, PSG, Nedbank, and others. The fintech scene is the one that I find much more exciting. I think that's where your blind spot can sit. If you're not watching what's going on in the fintech market and sector, what the new startups are doing, then you could get caught, swimming without too many clothes on, and that's where we emerge from. And so we must watch that space closely. What's coming out, what's been enabled, who's innovating, what they're doing, who's raising capital. So we keep, we're watching all those sectors: the big bad banks, the fintech startups, and then the big incumbents internationally that are disrupting their markets, and seeing if we can learn from them.
All right. The next question says, do you think EasyEquities will ever become more of a trading platform with investing real time instead of the delayed price?
Yeah, so this question comes from, I think, a little bit of confusion. The platform front end is delayed. The execution price is live. It's the JSE live price. So what you see is not what you get. And the reason for that is simply because if we showed you live prices, you would have to pay for them. And that's about 85 Rand a month, which for the 100 Rand investor, this is a waste of money. And in fact, for all investors, it's a waste of money. What we have implemented, and there are 20,000 investors on the EasyEquities platform that are using this, and it will soon go to another 10,000, is the ability for you to buy live prices. So you literally buy them. I think it ranges from, it's roughly about 20 cents a live price. So if you want to see a live price, you can. You just buy it on the platform, and then you can commensurately trade. But to the broader question, do you see us, enabling trading? You must. We have a business. We have a trading business, gd247.com, and let me put some warning signs around trading. 80% of traders lose money, but 100% of investors don't. And investing, the key differentiator between trading and investing is a long-term journey. And so you buy stocks you want to own forever, and you fall in love with them, and you own them until you fall out of love with them. And that means they must do something really bad for you to sell them. And what we're enabling here is an investment platform. Some people are using it as a trading platform. It was never our intentions to create that. But we understand that there are some friction points like live prices that we need to solve. And the only reason we have to solve them is that some of the stocks in South Africa are really illiquid. So what you see on a 15-minute delayed price doesn't reflect anywhere near accurately what's actually happening on the exchange. So that's why we built live prices. We didn't build live prices to invite in the traders. We've got a business that does that. And so, for me, we want to stay true to be creating an investment platform. And the better that becomes, it potentially starts to attract more traders. But that's not why we get out of bed in the morning. We get out of bed to create a platform for medium and long-term investors and ensure that they stay the course with us and create wealth and don't destroy their wealth by overtrading.
Okay, those of you who joined late, just remember we're going to have a playback option available at the end of this webinar. So in case there's certain points that you may have missed, we will have that playback available. Charles, this is going to be, I'm going to make it a two-part question for the sake of time. The first part, will Australians be able to buy shares on EasyEquities? And the second part is, will you add new country stock exchanges so that we can buy shares like stocks in Nigeria?
Yeah, first one, yes, Australians will be able to buy shares on EasyEquities. We're launching Australian shares to South Africans next week. And then about a month later, we'll launch to Australians. So that's on our radar. And Australia is our beachhead into Asia. Anyone who's tried to communicate with anyone in Australia will realize the time zone is just impossible. So we want to go into other Asian markets, and we're going to use Australia as the beachhead because it's in the right time zone. And that also signals the fact that we are definitely going to enable other markets. Again, it is by the weight of requests that we get from our customers. And the market that looks most likely after Australia are European and UK shares, and not places like Nigeria. We have very few customers asking us for Nigerian shares. But if the weight of customers' requests start to shift us to Nigeria, then we'll do Nigeria. So it's up to our customers to tell us what they want, and then we will make sure that we give them access. And for now, after Australia, the focus will be on European and UK shares.
The next question is about collaboration between EasyEquities and Capitec, and if there will be more collaborations with other banks.
Look, it's unlikely, and it's not because that it's contractually obliged that we don't collaborate. Remember, we have a relationship with Bidvest Bank already, so that's fine. And that will continue. And now obviously Capitec. But what are the chances of another bank wanting to collaborate with us? Well, I'm not sure. I don't know how many CEOs of other banks want to work with a fintech that's already working with Capitec. I think they might see it as a threat. So I'm not sure. I mean, we're not restricted from doing it. But I think corporate South Africa or banking South Africa doesn't like to do business cross partnerships. We would welcome the opportunity. We think democratization only happens in partnership. Bidvest is the realization of a dream. I mean, I'm not kidding when I said there were 5 years ago when we were 6 years ago now when we were conceptualizing this, we also thought about like who would be the perfect partners for EasyEquities. And Capitec, we wrote down Capitec, and they approached us 18 months ago and said, "Hey, would you like to be partners?" I mean, we almost fell off our chairs. So we would love to partner lots of banks and lots of financial institutions and help them allow them to be part of this democratization journey, because in the outcome, it's going to be much, much better for all of us. But South African banks don't play so well together. And so I think it's unlikely that we'll do another big bank partnership in South Africa.
Okay, this one's from Brenton. He says, how does EasyEquities facilitate fractional share purchases? Does EasyEquities buy in bulk after each day's user purchases?
Yeah, so the fractions are really easy. And again, it's such a when we were thinking about it, it felt like such a difficult thing to do. But once we did it, we realized how easy it was. But in order to fractionalize shares, essentially what we have to do is own one share on every listed company on the JSE. So that sounds like a lot, but in total, that's the all share index, which last time I looked was under 50,000 Rand. So it cost us less than 50,000 Rand to own one of every single JSE company, and therefore one share of every single JSE listed company. And therefore, when somebody buys a fraction from us, we sell them a fraction of the share that we own. So it's really easy to do with hindsight. So that's how we do fractionalization. In some markets, interestingly, only two that we found, fractional shares are a real thing. So the US and Canada both have fractional shares. We were the first in the world to electronically trade fractional shares, and we own the copyright and patent in South Africa. But in America, they've always had fractional shares, but the only way you could trade them was offline, so through a broker over the telephone, not online or not digitally. And that's, so in places like the US, we actually, if you buy a fraction of Berkshire Hathaway, we go and buy the same fraction. And then the second question is, we're clearing we're trading the whole time on the exchange. So all day, every day, as our customers trade, we commensurately go and trade.
The next question says, there's always been a belief that you should buy companies that you understand or that you at least love the product, but that doesn't always work. But it's better than putting money under my mattress, or worse, wasting it on stuff I don't need. What's your view on that?
Yeah, I mean, firstly, for certain, if you're going to put a lot of money into anything, make sure you understand it. And I think that's the cautionary. But then I'm going to say this, and if the regulators on the call, maybe they won't like it that much. But for me, how do we gain that understanding? And for me, again, I go back to the fact that I'm experiential. And if you're a shareholder of Amazon, reading their annual reports, reading Jeff's annual statement every year, then you're going to grow your understanding the longer you're invested. So for me, if I want to understand something, the fastest way for me to understand it is to invest in it. And so I will buy a part of it, because now I'm invested and I own it. And so I feel like obliged to understand it more. And I've got access to the inner circle of Amazon because I get the annual reports, etc. So if you're going to own a lot of something, 100%, you must understand it. If you can't write the test on it, don't own it. But if you want to start to understand something, then the beautiful thing about fractional shares is you can go and buy 1 Rand of it, or 5 Rand, or 10 Rand, or whatever is not a meaningful amount to you, and start that journey and build your understanding so that one day, if you do fall in love with that company for all the right reasons, you fully understand it.
The next question reads, what are the main plans for the next few years with expansion for both new systems geographically, and how will EasyEquities compete or compare with Robinhood in the US?
Yeah, so for us, the South African storyline is Capitec is a massive milestone for us. So it signifies the ability for us to distribute our product to somewhere near 15 million South Africans. The only thing that's missing from South Africa now is a distribution deal with a telco. And if we pull that off, and I wouldn't bet against us, then we've got access to distribute to all of South Africans' distribution. And so we're going to focus on doing that next. Once we've done that, then it's up to the team to make sure that we execute along those distribution rails and build this business. But I think that we are within the next 12 months, and COVID might delay it, but I think within the next 12 months that we will end up executing a deal just like that. And then the South African opportunity is locked down. The focus then shifts, certainly for me, not for the entire team, but for me and parts of my team, is how do we take this business to other places. And so our focus will shift to international markets, starting with Australia. Australia needs to get to a point where it's got 10,000 customers, and it will start to it will have its own momentum and traction, and then we can leave that alone. And then we've got to think beyond Australia, where we're going to take it. And the places that we're thinking about is Africa, specifically East Africa. We like the fintech ecosystem there. And then Europe. And again, not not what I would call first world Europe, Eastern Europe, and the sort of lower value European centers where the competitors aren't there. And then how do we stack up? For us, Robinhood, the freemium model doesn't work, we don't believe, because if you're getting, there is no such thing as a free lunch. And if you're getting something for free, you're paying for it somewhere else. And if you take Robinhood, and I'm a huge Robinhood fan, so they mustn't take this as a disgruntled competitor, but it's free brokerage, and it's free brokerage on some stocks, not all of them. But then if you want to do leverage trading, which they charge you, I think, about 700% higher than the lending rate in America. So they make all their money on lending, which means then that their incentives as Robinhood are for you to borrow money and invest using borrowed money. And for me, that creates a misaligned incentive, because that doesn't create wealth. They've got 300% gearing on their stocks that they allow you to do at a 7 or 8% interest rate. Just out of interest, the average return on a US stock is 7%. So they're asking you to borrow money to buy something that isn't going to appreciate faster than the cost of the funding on that product. So for me, that business model is doomed to fail unless they change their cost structures. And that's the problem with free, is that you give something away and then you take it all back somewhere else. So for us, that's not our business model. Our business model is to be fair and in the top quartile of cheapest in everything that we do, to give our customers the ability to earn free. And those who are thrivealists like me know that we can get free brokerage if we refer people and do an educational course and do cool things that help us build our community, then you get it for free. And for me, that's a fairer model, because we're not incentivized to take anything away from you because we've given you something for free. You've brought a customer to us. You've upgraded your education, so you're going to stay longer. And for that, we're prepared to give you free. And so whilst I love the freemium model in that it does disrupt, you can't just disrupt. You also have to be, you've got to be disruptive, and you've got to be sustainable. And I think some of these freemium businesses are not sustainable. And I mean, let's talk about one that I think is going to find its challenges. Acorns, which has been incredibly disruptive, also free. It's been around 12 years now. It's still not profitable. At what point do the shareholders turn off the taps and say, this thing can't work? And then you create this wave of disappointment. So that's a very long answer for a very short question, but I think it answers it.
Okay, we've got about 2 minutes left. I'm going to make this one a short question, and some of the questions that we don't get a chance to, get through, I'm pretty sure, Charles, this gives us an opportunity to reconvene again so that your shareholders can engage with you, because I think people got excited with the answers that you're giving. So this one says, how has the EasyEquities RA take-up been?
I think it's about to go over 100 million. So that doesn't meet our expectations, but it's starting to get some traction. Excitingly, we're adding another line of products to it. So unit trusts are going to go onto the RA platform very soon. I think it's weeks away, maybe a little bit longer. And the reason for that is that most people have got their RAs in unit trusts, and a lot of them want to transfer in those assets. And for that to happen, we need to have unit trust. So we're adding unit trust to the platform. So you can have a really low cost experience of unit trust, shares, ETFs, etc., and managed solutions. And then once we've got the unit trust, we'll start to commensurately market that platform more. We haven't marketed a lot. It's sort of, people have discovered it on the platform, but once the unit trusts are in there, we'll start marketing it more aggressively.
Charles, I'm going to squeeze in one quick one. Cindersa says, what can she do with 250 Rand if that's all she can afford per month? Can she continue to try to build a portfolio of scale? What advice do you have?
Yeah, I mean, 100%. You go and compound 250 Rand over 30 years, and you'll see what an incredible number that is. So 100%, 250 Rand is a meaningful amount. And, if you don't know what to invest in, then there are lots of ways to work out what you should invest in. But I would start with buying ETFs, and pick what the asset managers pick. I see what's in those ETF bundles on our platform and pick a few of those. And that's it. And then just stay committed to it. And once you become an investor and a shareholder, you'll start to educate and understand more. And you might fall in love with some stocks that you want to buy directly, hopefully Purple Group after this call. And then, take it from there. But 250 Rand is a lot of money over the long term. It's not going to get you rich in 5 years, but you do it for 50 years and go and have a look at the magic of compounding interest, which is probably the subject that our schools let us down on. They should have spent our whole maths curriculum teaching us about compounded interest. And if they did, they would have turned us all into investors, which would have been a much better use of maths for me.
Okay, Charles, unfortunately, we've run out of time, but like I said, this gives us an excuse to have another webinar again and have more people engage with you and ask as many questions as they like. Thank you so much for availing yourself and being transparent and basically, sharing with us some of the principles that the business was built on and the journey since then. And I'm sure it's going to be exciting going forward. Thank you so much to the attendees and the participants who asked their questions. We tried to get through as many of them as possible, but like I said, this gives us an opportunity to get Charles back on and we can engage with them once again and see how the story unfolds. That's it for me, and we'll see you at the next webinar series, which is later on this week. Thank you so much and goodbye.